Very good evening all of you. Very good evening all of you. Please confirm if my audio and video is clear to everyone and the screen is properly visible. Please confirm if everything is okay. Good evening Siddhant, good evening Arun, good evening everyone. Okay. So let's start today's session. I believe all of you are revising the concepts properly after the revision session as well, and solving your revision kit or the exam kit, whichever book you are referring to, and solving it. Okay. In case if you have any queries, definitely you can reach out to me and we'll try to resolve it off. Okay. Now, starting with the topic for the today, that is share based payments. The first topic for the today, share based payments. Now understand guys. Okay. Understand. What is the meaning of share based payment? What is the meaning of share based payment? Understand guys, when we pay to anyone in the form of shares, when we pay to anyone in the form of shares for the goods or services that we have received, that is called share based payments. Now see, understand, there are few things which we need to understand about share based payments. It is then only you can understand, or you can write the questions about share based payments, otherwise you will face challenges in this one. Okay, now understand, when you purchase goods or you purchase services, or you take services, when you purchase goods or you take services, you can pay in the form of cash. That transaction is not covered here. You can pay in the form of shares of my own company. Okay, that transaction is covered here. You can pay in the form of shares of any other company. That transaction is not covered here. You can pay in the form of cash, but based on value of shares of my company. That transaction is covered here. So what is the coverage? If you are solely paying in cash, not covered. If you are paying in any other form, like you can say equity shares of another company, that transaction is not covered. So which transaction is covered? The transaction which is settled in the form of equity shares of my company. My company means the entity which is doing the transaction. Okay, or cash based on the shares of my company. Okay, all those transactions are covered here. Okay, see what is the meaning? It's a contract for purchasing goods or obtaining the services which is settled in the form of equity shares of my company, own company, or cash based on the value of the equity shares of my own company. Okay, or cash based on value of equity shares of own company, provided vesting conditions are satisfied. Now you must be wondering, what are vesting conditions? Definitely we'll discuss it off. Okay, going forward, basically vesting conditions are the conditions which should be satisfied before the shares are issued or before the payment based on shares are done. Okay, so these are the vesting conditions. Now basics about share based payments. Understand, share based payments can be of two types, equity settled and cash settled. Whenever it is an equity settled or cash settled, understand, in both the cases we record expense and the corresponding credit is given to reserve in case of equity settled, and the corresponding credit is given to liability in case of cash settled. Why? Understand guys, when you are settling in the form of cash, means there is an obligation to give, there is an obligation which is coming through contract, right? So it's a contractual obligation for what? To deliver cash or any other financial assets, right? So don't you think that's a financial liability? And that's the reason why we record a liability for this one. Okay, but now in this case again there's an obligation, contractual obligation to issue equity shares. So again link this one with financial instruments, link this one with financial instruments. So what do we do? Whenever there is a contractual obligation to issue equity shares of the company, of my own company, that's an equity. Whenever I have a contractual obligation to give cash, to deliver cash, it's a financial liability, and that's what we are doing here. In the case of equity settled, we are recording reserve, and in the case of cash settled, we are recording it as a liability. I hope you are understanding this point very well. Fixed for fixed test. Nutan, you are not required to do fixed for fixed test here, okay? I'm just linking, trying to link it with that, okay? So it's not exactly that, but I'm trying to link it with that so that you understand it easily, okay? Now, whenever it is a reserve, you know that again linked with the financial instruments, okay? When you link with the financial instruments, equity, tell me, does the value of equity changes? No, the value of equity remains constant. The value of equity remains constant, right? So it's because of that reason we say that whenever it's equity settled, we will take the fair value on grant date. We will take the fair value on the grant date, and subsequently we will not change this value. So whenever it's equity settled, we'll take the fair value on grant date. But when it's whenever it is liability, see, understand guys, whenever it's liability, the payable amount changes, and the payable amount changes, right? If whenever the fair value changes, the liability changes, right? And we have to remeasure our liability, right? So we have to consider fair value on each reporting dates for cash settled, right? Because liability gets remeasured on every reporting dates. Let me give an example. Do you remember foreign currency monetary items? Right, right? Those were liabilities, right? We used to remeasure it on every reporting dates. Just linking it with that, okay? Trying to explain with the help of an example. I believe these points are clear to all of you. Now coming to expense. How do we record expense? See, we discussed about liability, but now let's discuss about expense. How do we record an expense? Understand guys, the formula for recording the expense is given by the standard. This is the formula for recording the expense. Understand? Options per employee multiplied by number of employees. Okay, basically you can say options that are expected to vest. For this, standard says that you have to take the best estimate. Best estimate. Why best estimate? Because it might be the case that the employees might resign during the year, or employees might not satisfy the performance conditions, or we can say it as a vesting conditions, or it might be the case that the employees are not in the payroll of the company. Employees are not in the payroll of the company on the date when the shares are required, when the shares are supposed to vest. Okay, so take best estimate. Now take fair value of option. Now understand fair value of option. What fair value will we take? If it is equity settled, we'll take fair value on grant date. We'll take fair value on grant date, and if it is cash settled, we'll take fair value on reporting date. Right? Now expired period by vesting period. Expired period means the years for which service is already provided. Cumulative, right here, cumulative. Okay, divided by vesting period. So this will give you what? The total expense required to be booked till date. Now from this you have to deduct expense already booked till last year. What is the expense totally booked? Cumulative expense already booked. Cumulative till previous year. Okay, so that this will give you the amount of expense to be recorded in the current year. Is it clear, everyone? Come on guys, please confirm. Now applicability. Let's understand the applicability. Guys, understand, whenever you receive the shares in the capacity of a shareholder, that transaction is not covered here. When you receive the shares in the capacity of a vendor-vendee relationship. Now let's suppose, come to the meaning. Is it written contract for issue of shares to the shareholder? No. Contract for goods or services. When I purchase the goods or when I obtain the services, and in lieu of that, if I am giving you the shares of my company, that transaction is covered here. But if I am giving the shares of my company as a bonus to the shareholder, is that transaction covered? No, that transaction is not covered. If I am giving the shares as to my shareholders as a right issue, is that covered? No, that transaction is not covered. If any transaction happens in the capacity of a shareholder, that transaction is not covered here. But if the transaction is happening in the capacity of a vendor-vendee relationship, that is covered here. Now let's suppose Reliance, understand guys, Reliance, Mukesh Ambani is a shareholder of Reliance, okay, Mukesh Ambani is a shareholder of Reliance. Now, if the Reliance company gives shares to Mukesh Ambani as bonus shares or right shares, that transaction is not covered here. But now let's suppose Mukesh Ambani gave his services to Reliance, and for that services he is not taking cash, he is taking the shares of the Reliance, he is taking the shares of Reliance. That transaction is covered here, okay, is covered here. So transactions with the shareholders but in the capacity of vendor-vendee relationship are covered here, okay. Even if the transactions are happening with the shareholders, those transactions are covered, but the relationship then at that point of time should be vendor-vendee relationship. I hope you are understanding the applicability, guys. We as a student give very less importance to this applicability paragraph, but this is a most important part of this standard. This is the most important part of this standard, I can say, okay. So transactions in capacity of shareholder are out of scope, but the same transaction which is done with the shareholder but in the capacity of vendor-vendee relationship are covered here, okay. Now, so it was, I believe it was easy so far. Now comes the a complex point and a very important point as well. Options with settlement choice. With settlement choice, what is the meaning of settlement choice? See what happened. I'll give you an example before I explain this part. Understand? So far, let's suppose what happened. Zomato gave ESOPs to its employees, say that if you remain in the company for 3 years, I will give you the equity shares of my company. This is called equity settled share based payments. Now another, Zomato gave stock appreciation rights. Zomato gave stock appreciation rights to its employees, saying that if you remain in my company for the 3 years, if you remain in my company for 3 years, I will give you cash. I will give you cash based on whatever is the price of equity share. Then I will give you cash based on that. Okay, whatever is the price of equity share after 3 years, I will give you the cash. I will not give you equity shares, but I will give you cash. If you want equity shares, you can purchase it from the open market. You can purchase it from the open market. I will give you cash. Okay, that's called cash settled. Now the third type which we are discussing now is, I am saying, see, there's a choice. There's a choice. Okay, I am issuing you the options now. After 3 years, you assess. You want cash, I will give you cash. You want equity shares, I will give you equity shares. That's a choice I have given. To the counterparty, I have given a choice. To the counterparty, I have given a choice that if you want equity, I will give you equity. If you want cash, I will give you cash. Okay. Vishaka has a query. Goods purchased consideration paid after 3 months in equity or in 6 months in cash equivalent to equity. Is it covered? Purchased consideration is paid after 3 months in equity. Or 6 months in cash equivalent to equity, is it covered? Yes, Vishaka. See what is happening. See, purchase. I have purchased goods. Vendor-vendee relationship is there, right? Now I am paying in equity shares. That's covered. I am paying the cash based on equity shares. That is also covered. Okay. Options with settlement choice. Options with settlement choice. Now, so this is what we are discussing. Now understand, guys. What are the steps to account for it? Can you please, all of you, come on guys, all of you, can you, don't you think this is something like a convertible loan note, optionally convertible loan note? Don't you think it's somewhat like optionally convertible loan note, wherein there was an option to the instrument holder that if they want cash, I will give you cash. If they want equity, I will give you equity, right? So in that, what did we use? What are the steps? First, I used to calculate the value of the liability. Then I used to calculate the value of the instrument, and from that I used to calculate the residual portion. So the value of liability will remain intact as that value. The residual portion will become the value of equity, right? Tell me yes or no? Neha, Nutan, Vishaka, Siddhant, Ayush, come on guys, tell me. Arun, all of you, come on guys, please tell me. Right? Now that's what is happening here as well. So on the first date, as step 1, you have to calculate first the fair value of the equity option. Okay, if assuming all option holders, I will write option holders as OH. Assuming all option holders will opt for equity. Okay, calculate the fair value of equity option. Now, as part of step number 2, calculate fair value of liability option. Assuming all option holders will opt for cash. Okay. Now this is what. Now link it with the financial instruments again. So what will happen? This financial liability will be called as will be recognized as liability. Okay, but understand guys, understand. Okay, we will remain this intact. Okay, but now what we'll do? What is the value of equity option? So we'll say okay, that this way. Not just a minute. We say that what is the fair value of equity option? What is the fair value of equity option minus what is the fair value of equity option minus what is the fair value of liability option that I have already recognized? Okay, if any balance remains, this will be called as equity. This will be called as value of equity. Otherwise, let's suppose understand, if the fair value of liability option, cash option is more than the fair value of equity option, will we recognize any equity? No. If the fair value of liability option or the cash option is less than the equity option, in that case the differential will be recognized as equity. Okay, will be recognized as equity. Equity cannot be negative. I will write here, cannot be negative. What is the meaning of this one? Meaning there, the meaning is again, if the liability is greater than equity option, if the value of liability is greater than equity, you will not recognize any equity. Okay, I'll explain the meaning of this one. Okay, come here. Let's suppose, see, the fair value of equity, assuming all the option holders will opt for equity option, it's 20, and the fair value of liability, assuming all the option holders will opt for liability, it's 10. So what will I do? I will recognize this liability 100 over the vesting period. Okay, and what is the differential? See, what is the differential? 20. This 20 will be recognized as equity over the vesting period. But now let's suppose this liability is 130. Had this liability been 130, will we recognize any equity? Tell me, will we recognize any equity? Can I say my equity is negative 10? Can I say my equity is negative 10? Can I say my equity is negative 10? No, I cannot say that. Is this point clear to everyone? Generally, this is the area where a student makes mistake. Okay, so that is not holding good. Okay, I believe all of you are clear on this point now. Okay, now, so this exercise has to be done on the grant date. Now, on every reporting date, what we will do? We will remeasure liability component, and I will record expense as I use following this logic. Okay, following this formula, I will record expense for the liability, and I will record expense for the equity. Now here I will use the grant date value, here I will use the value on every reporting dates for liability option. Okay, now on exercise date, what will I do? Understand guys, if all, why first 3 steps calculate only on grant date, why not in subsequent measurement reporting date? Because liability changes on every reporting date. Understand, Nutan, tell me, when you for a convertible loan note in financial instruments, the separation of liability and equity, don't you think is done on the first date, on the date when you issue the instrument, or do you do every year? Tell me. The separation is done on the first day or every year, right? It's done only on the first day, right? It is done only on the first day. You separate that this is my liability, this is my equity. This is my liability, this is my equity, right? The fair value might change, so that accordingly my expense will change or decrease or increase, right? My value of equity and liability should not increase or decrease. Is it clear, Nutan? Is it clear to you now? Okay, now I'll take up example and explain also, Nutan, don't get confused. Now, if it is on exercise date, on the date when the employees are exercising it, okay, what will happen? Tell me. Cash settled. So if it is cash settled means all the option holders want to take cash. So what will I do? I will pay the liability, that is provision for SAR account debit to bank, or SBP liability account debit to bank, okay, and whatever is the balance in equity, I will transfer to general reserve, because this is not holding good now. Now let's suppose all the option holders want to go for equity now, all the option holders want to go for equity now, okay. Then what will I do? In that case? So first I will transfer whatever is the value of liability, I will transfer this to SBP reserve first, okay. Whatever is the value of liability, first I will transfer it to SBP reserve, and from SBP reserve I will issue shares, and the differential will be transferred to securities premium. I hope it is clear to everyone. Now let's suppose if partly in cash and partly in equity, then first what will I do? Provision for SAR account debit, and from that I will pay to the one who want cash settlement, and the remaining I will transfer to SBP reserve, From SBP reserve I will issue share capital, and I will differential I transfer to securities premium. But for the portion for which the employees opted cash, that portion is transferred to general reserve. See, basically this is what this plus this is equals to this. That's what I've done. Provision for SAR account debit to bank to SBP reserve, SBP reserve account debit to share capital, securities premium to general reserve. That's what I've done. A combo. Very good, Vishaka. A combo, right? Now understand. I will explain you the basic treatment of this one, okay, and then I'll move ahead in this one through an example. See, the fair value of equity on grant date is 120, and the value of liability is 100. Okay, so what you will say, your equity is 20. So here you are saying, see here now, here you are saying your this much financial your SBP liability you have to record SBP liability, and you have to reserve SBP reserve, okay. This is 120 liability, you have to record how much? 100, right, for over 4 years, over 4 year vesting period. 1 2 3 4. For this 100, let's suppose here the fair value is, let's suppose 110. So what is the expense to be recorded? 110 by 4. So can you tell me what is the amount? It's 27.5. Now let's suppose here the fair value is let's suppose 90. Here the fair value is 90. So what will I record? 90 multiplied by 2 by 4 minus 27.5, which is equals to how much? 45 minus 27.5 is 17.5. Right. Let's suppose the fair value here is again you can say 120. Okay, not 120. I'll not take 120. You can get confused if I take 120. I'll take fair value of 130. Okay. 130 multiplied by 3 by 4 minus 27.5 minus 17.5 is how much? 130.4 130 multiplied by 3 by 4 minus 27.5 minus 17.5, that comes to 52.5. And let's suppose here the fair value is 150. Okay, so it will be 150 minus 27.5 minus 17.5 minus 52.5, which is equals to how much? 150 minus 27.5 minus 17.5 minus 52.5, right? 150 minus 27.5 minus 17.5 minus 52.5 is 52.5 here as well. It comes to 52.5 here as well. Now SBP reserve is 20, right? So 20 is recorded as an expense over 4 years as 5, like this. SBP reserve is recorded with 5, 5, 5, 5 as an expense, right? So now at the end, your provision for SAR will have a balance of how much? Tell me. 150, and your SBP reserve will have a balance of how much? 20, right? Now if you want to do full cash settlement, you have to pay this to cash and you will transfer to general reserve. If you have to do full equity settlement, then you have to transfer this to SBP reserve, and from here you will issue equity shares, and the balance you transfer to securities premium. If you have to do partially, you have to do the combination of both. I hope it is clear, everyone. Nutan, Vishaka, Siddhant, Ayush, Arun. I hope it is clear, everyone. Neha, okay, wonderful, wonderful. Now moving to next topic, that is vesting condition. What are vesting conditions, guys? Understand. Nutan, is your query answered? Nutan, is your query answered? You understood now? Still in doubt? Understand, no? Basically when we do split, we always do split on the grant date. Okay, we don't split every year. Okay, we don't split every year. Okay, now yes, Nutan, we don't do split every year. Okay, if we do split every year, then don't you think that's again we are changing the plan every year? So so that's a stand that we, whenever we do the split, we do split on the date of issue. Okay, identify, okay, this is my liability, this is my equity. That's what is split done. Now account for it. Okay, the accounting will become much complex if we do that way. Okay, and will not be logical as well. Now understand. Okay, Siddhant, please explain again general reserve part. Understand, Siddhant, whatever is the SBP reserve for which we have issued, see, if we issue cash, if we settle in cash, that portion of SBP reserve should be transferred to general reserve. Okay, so let's suppose here, see, there was an SBP reserve and we issued cash, so I transfer it to general reserve. There was equity settled, so I transfer the whole to SBP reserve, and from here I issued equity shares. So again, see here, here I am doing part settlement, part in cash, part in equity. So don't think the part for which I have done cash settlement, I will transfer the SBP reserve to general reserve. Okay, Siddhant, is your query answered? Now come to a new topic, that is vesting conditions. If I will explain the vesting condition in a general term, means the conditions which are required to be settled, conditions which are required to be satisfied before the shares are issued to the employees, or you can say to any vendor. Okay, yes, but whatever is not used is transferred to general reserve. Okay, to employees or to any vendors, okay. Now see, again, the condition can be two types of. One is non-market condition, the one which we have seen so far. Okay, that like service condition, that the employees are required to do a service of 3 years, it is then only I will give you the equity shares. Or performance condition. Performance condition can be, I will give you equity shares, So I will give you equity shares or I will give you cash provided you have reduced the cost of the company by 20%. By 20%. Tell me, don't you think this is something within the control of employees? This is something within the control of employees. Tell me, guys. This is something like service condition, right? I have to perform for 3 years. Yes, it's my control. If I want to perform for 3 years, I will perform. If I don't want to perform for 3 years, I will not perform, right? It's in my control. Reduce the cost by 20%. So if I know if it's practically possible, yes, I can reduce that. It's in my control. If I work effectively, I can reduce the cost of the company as well. So it's within the control of the employee. It's within the control of the employee. Now, another condition is market-based vesting condition, wherein the condition is based on market price of the shares of the company. Now, let's suppose if I say to my employee that I will give you ESOPs provided you increase the value of my equity shares by 20%. Tell me, is it within the control of the employee? How can employee increase the market price of the share? Tell me, how can employee increase the market price of share? It's not within the control. It's not within the control of the employees. It's not within the control of the employees, right? Not within the control. Now, treatment, understand. Whenever it's a market-based condition, we take the best estimate. We take the best estimate and recognize expense. We take the best estimate and recognize expense. But whenever it is a market-based condition, your standard says that these market price of shares are already the increase or decrease or the satisfaction of these vesting conditions of market-related vesting conditions are already factored in the fair value, okay, of the option. So totally ignore it off. Just ignore it off. Or I can say in normal terms, no treatment. In normal terms, I can say no treatment. I hope it is clear, everyone. Okay. Now let me give you an example as well, okay, so that you will understand it better. See, I have already drafted an example for you. So the example is Zomato granted 100 options to its employees. 100 options to its employees, okay, to one of its key employee, okay, not to all, only one employee, okay, which will vest after 3 years. Fair value on grant date is 12 per option. Vesting condition, see, there are two vesting conditions, case A or case B. Case A is cost decreased by 20%. Tell me, is it a market condition or a non-market condition? Is it a market condition or a non-market condition? Cost decreased by 20%. Tell me. It's a non-market condition. Very good, Nutan. Now, if share price increased by 25%, is it a market condition or non-market condition? Tell me. It's a market condition or non-market condition? Very good, Neha. Now, market. So it's a market condition. Now, analyze. Let's see. See what happens. The difference. If it's for non-market condition, forget this one. Forget case B. Don't see case B now. Okay, don't see case B now. Understand this one. For case A, that is non-market condition, 100 multiplied by 12. See, what is the 100 options? 12 is the fair value, right? And 3 years. So 1 by 3, 400. Now, see, okay, first year it was assumed that the cost decreased by 20% will be satisfied by the end of third year. Okay, so that's why I've written red tick. Okay, second year it's not estimated. Basically, the employees or the company, the entity is estimating that the employees will not be able to satisfy this condition. Employees will not be able to satisfy this condition. Tell me, will I give him any option? If the employees will not be able to satisfy this condition, will I give him this? Will I give him the option? Tell me, will I give him the option? No, right? So that's why, see here, I have written here 0 options. Right? 0 options multiplied by 12 multiplied by 2 by 3. See, minus expense already booked. So what does it happen? Expense gets reversed. See, I am applying best estimate. What did I say for this one? Apply best estimate and recognize expense. 3 for non-market, I am applying my best estimate and applying my best estimate, right? I am applying my best estimate. And in the third year, again, it says the cost condition, the performance condition is achieved. In the third year, the performance condition is achieved. So what I will do? 100 multiplied by 12, multiply 3 by 3, minus expense already booked is how much? Tell me. 400 minus 400 is 0. So minus 0 is 1200. So I will book the whole expense in this year now. So this is called estimate based booking of expense. Estimate based booking of expense. But now, what if there is a 50% probability of achieving the condition? I use we see more likely than not. Okay, more likely than not. Okay, more likely than not. Now, case B, that is market condition. In this, see, in the year number 1, it's assumed that market condition will be satisfied. In year number 2, we are expecting that the market condition will not be satisfied, and in year number 3, we are expecting that market condition will again be satisfied. But irrespective of that, I have booked equal expenses in every years. Okay, I have booked expense in all the years. I have booked expense of all the years. I have booked expense in all the years. Okay, Vishaka, I already answered that we see more likely than not. We see more likely than not. Okay. See, that's a probability, right? That's a probability. We are booking the provision. When do we book provision? Tell me. When there is a more likely than not. That is, the probability of happening is more than 50%. It is in that case only we book provision. And that's a question IOS which you are asking is from an IAS 37 and not from share-based payments. Okay. I hope it is clear. I hope it is clear. See, that's what I have written here. For market condition, ignore whether it is being satisfied or not being satisfied. Doesn't impact. Very good, Nutan. It does not affect. Okay, it does not affect. Is it clear, everyone, so far? Come on, guys, please tell me. Is it clear, everyone, so far? Okay. Repricing or modification. What is the meaning of repricing or modification? Many times, option means equity or cash. Yes. Vishaka, see, I told already that market-based condition means what? When the condition, let's suppose I told to my employees that I will give you equity shares of my company if the market shares increases by 20%. Okay, to what it is now, if it increases by 20% till the end of third year, I will give you the ESOPs. I will give you the ESOPs. Okay, that's called a market condition. The vesting condition is linked to the market. Okay, that's not in the control. So whenever it's not in the control, I book expense irrespective of whether it is being satisfied or not satisfied. I book my expense whether this one is satisfied or not satisfied. Okay, is it clear, everyone? Now moving on to repricing or modification. Now understand, guys. Okay. Repricing. When does it? What is the meaning of repricing or modification? See, guys, what happens is many times the share price of the company starts falling. It starts to fall. When it falls substantially, the ESOPs become less attractive. The ESOP becomes less attractive. So what does the company does to make it more attractive? See, generally, what is the purpose of giving ESOPs? To retain the employees, right? If the ESOPs become less attractive, the employees will start leaving the company, right? The employees will start leaving the company. So to make it more attractive, see, definitely the company or the entity cannot change the market price, right? That they cannot change the market price. But tell me, what is the parameters of determining the fair value? The market price, the increase or decrease in the future market price, and the exercise price. Exercise price means the price which the employees pays to the company to take the shares, right? So now the company cannot change the market price of the shares. The company cannot change the future market price of the shares, but the company can increase or decrease the exercise price. So to make it attractive, company will decrease the exercise price, and once the exercise price decreases, the fair value of the option increases. The fair value of the option increases and it becomes more attractive. Again. The whole purpose of retaining the employees again gets satisfied. Okay, so this is the meaning. Okay, this is the meaning. Okay, generally I write the meaning as well. A decrease in exercise price of option, okay, thereby increasing fair value of option. Now the question that comes up is, how should this be treated in the books of accounts? How should this be treated in the books of account is the question now. See here the treatment. See the treatment of repricing. Let's suppose, see on this date, so let's suppose I'll write here like this, 1, 2, 3, 1, 2, 3. There are 3 years are the vesting period. 3 years is the vesting period. Okay. At the end of during second year, the options started becoming less attractive. Options started becoming less attractive. So the management did the repricing of the shares. Management did the repricing of the options. It is decrease of the exercise price. So due to which the fair value will definitely increase. Now, so what the standard says is, whatever accounting you were doing, continue doing it. Now, whatever is the fair value increase, okay? Whatever is the fair value increase, and how will you calculate fair value increase? What is the fair value after repricing, and what is the fair value before repricing? Okay, this is called the increase. This increase should be apportioned over the remaining period, that is from here to here. Okay, here to here. You have to record as an expense. Record fair value increase as expense. Is it clear, everyone? To be accounted for prospectively. Very good, Ayush. Very good. Okay, that's what I went to say, and I've already written here, so I think it doesn't make sense to write it again. It will just confuse you guys. Is it clear, everyone? The repricing. Is it clear, everyone? The repricing. Now comes cancellations. Now how the cancellation should be dealt with? Basically, when the option plans are cancelled, not given more. Okay, you can say for the sake of understanding, yes, you can, as of I have given more ESOPs to them. Okay, basically what I have done, I have made it, I have given more value to them. Okay, basically you can say, Vishaka and Nutan, that we have given more value to them. Okay, and this value is a cost for the company, right? And so that we will record that this is an expense over the remaining years prospectively. Okay, cancellations. Now, cancellations means I have cancelled the option plans. This happens in both equity and cash. Yes, Nutan, this happens in both equity and cash. Okay, understand. Cancellations. I am discussing it with the help of an example rather than writing the treatment. I am discussing with the help of an example. Understand. Let's suppose I have to give 2,000 options to 10 directors. I have to give 2,000 options to 10 directors, and the fair value of each option is 120. Okay, on the grant date. Okay. Now, forget cancellations now. Tell me, on the grant date, will you pass any entry? No. At the year end, when? What is the entry that you should pass? Tell me. You will pass employee benefit expense account debit to share based payment reserve, assuming it is a equity settled, right? Now, what should be the amount? 2,000 multiplied by 10 multiplied by 120 and divided by 3 years, because the 3 years is the service period, right? 1, 2 and 3 years is the service period, right? 3 years is the service period. So I will record over 3 years. Right? So this is the expense that I will book. Tell me yes or no. I hope this entry is also clear to everyone. Now, coming to this date, the cancel date, the date of cancellation. So what will I do? See, on the date when the options are cancelled, first thing that we do, Book all the remaining expense. Book all the remaining expense. All the remaining expense. How? So what is it? Tell me. 2000 options, 10 directors, 120 is the fair value on the grant date. I have booked 8 lakh as an expense. Remaining is 16 lakh expense. So first book all the expense. Okay. Employee benefit expense account debit to share based payment reserve. Okay. So tell me what is the balance in share based payment reserve? What is the balance in share based payment reserve? 8 lakh plus 16 lakh is 24 lakhs. Tell me, is it clear everyone so far? Right now, see here it says now I have to pay compensation at the rate of 95. I have to pay compensation at the rate of 95 to my employees, because if I'm cancelling, right, so I have to give compensation to the employees also. I have to give compensation to the employees. I have to give at the rate of 95 per option. I am giving the compensation. Okay. Now, and the market price is 99, and the fair value of the option as of on this date, fair value of option on this date is 90. Now see what does the standard say? Fair SBP reserve has a balance of 24 lakhs, compensation to be paid is 95, and the fair value on this date is 90 per option. Standard says that from SBP reserve you can pay to the extent of fair value on this date of cancellation. From SBP reserve you can pay to the extent of fair value of the option, on the date of cancellation. So SBP reserve is 24 lakhs. But tell me, from SBP reserve how much amount can I pay? Only till 90, and the balance will be transferred to general reserve. The balance will be transferred to general reserve. Now, but I have to pay how much? 95 per option. I have to pay how much? 95 per option. So the remaining, the standard says the remaining, that is 2000 per option per director, 10 directors. So I have to pay 95. I have already adjusted 90 from SBP reserve. The balance has to be adjusted from P&L. The balance has to be adjusted from the P&L, right? So the journal entry will become this way: 2000 multiplied by 10 multiplied by 90 is 18 lakhs. 18 lakhs has to be paid from here. Okay, and here 2000 multiplied by 10 multiplied by 5 is 1 lakh. Okay, now here is 6 lakhs. Here is again 1 lakhs. Okay, so now see, just I'll do one more analysis. 18 lakhs plus 1, if you add here, is how much? 19 lakhs. And what is the calculation of 19 lakhs? It is 2000 multiplied by 10 directors multiplied by 95 per option. So it is how much? 2000 into 10 into 95 is 19 lakhs. I hope it is clear to everyone. Can you please see this journal entry? Okay, no equity settle. Nutan, I have cancelled the option. See here, I have cancelled this option. So there is no question of equity settle or cash settle. Okay, this for equity settled. Okay, fair value and intrinsic value seems is same. Nutan, no. Fair value and intrinsic value is not the same. Fair value and intrinsic value is not the same, because standard says that IFRS 2 says that fair value of an option has to be calculated using a different set of model called Black-Scholes model. Okay, it suggests to use Black-Scholes model. Intrinsic value is directly calculated. What is the share price minus the exercise price is the intrinsic value. Okay, but the Black-Scholes model use even the future projections, that will it increase or will it decrease, okay, and taking the probability factor. And I believe Vishaka and Nutan, we have discussed this in our regular classes also, that how that valuation is determined. Okay, so let's not go into detail for that as of now. Tell me guys, is it clear everyone so far? These are the same examples which I use in my regular classes, guys. So so I believe it should be understandable for all of you. did I say anywhere intrinsic value? Tell me, Nutan. I said fair value, right? I said fair value. So what's there to confuse? Tell me, Nutan. What's there to confuse in this one? Tell me your query. It's then only I can resolve it. No, Neha, it's not about fair values for an option and intrinsic values for a share. No. It's fine that fair values for the option also, intrinsic values also for the option, right? But intrinsic value was suggested as per the erstwhile standard, you can say the guidance note in ICAI for Indian scenario, okay? Indian scenario. If less than 90, fair value is less than 90, so I will pay, let's suppose the fair value is 85. Let's suppose if the fair value is 85, sorry. Let's suppose the fair value is 85. So what will I do? I will pay 85 from SBP reserve. I will pay 85 here. I will pay at the rate of 85 here, and the balance 10 I will transfer here to P&L. The balance 10 I will transfer to P&L. Nutan, 90 minus 9 is 90 fair value. From where did you derive 9? Tell me. From where did you derive 9? What is 9? Tell me what is 9? What is 9? Do you think 9 is intrinsic? 9 is exercise price? Did I say anywhere 9 is exercise price? Tell me. Did I say anywhere? No, right? Please don't make this topic unnecessarily complex. It is a very easy topic. No, don't assume, Nutan. Don't assume that. Okay? If the question has to give data, they will specifically give it. Okay? See, if the employee leaves, it's cancelled for him. But now we are not discussing that. Okay? So if the employee leaves, that is called the option lapses, right? And the amount that we have made is transferred to general reserve. Okay? But in this case, entity is cancelling the option for everyone. Okay? Whatever difference is there between the compensation paid and the fair value and the rate of cancellation will go to P&L. Yes, Yogesh. Yes, you can say that. Yes. Okay, but generally I explain it as whatever is the fair value you have to pay from SBP reserve, and the differential has to be transferred to P&L. Okay, I hope this is clear, everyone. Now let's move to a new topic, that is employee benefits. Let's move to a new topic, that is employee benefits. A very easy topic, And you know the best part of it, the employee benefits. Though in this topic we will study 5-6 points, but the examiner will ask only from 1 point. Because there is only 1 point which has something substantial in that. Okay, which has something substantial there. Yogesh, you are saying it's not easy because you do not have practiced much questions. Okay, please practice questions. And after this revision session also, I believe it will be easy for you, for everyone. Why do you want to go for shortcut, Nutan? Why do you want to go for shortcut? Let's understand the whole standard, right? It's very easy. Let's study together and make it easy. If you don't think it's easy, let's study together and make it easy. Okay. Topic 2 for the day, that is employee benefits. What are employee benefits? The benefits which we pay to the employees. The benefits which we pay to the employees are called as employee benefits. Now, benefits means salary, wages. It might mean a provident fund or the gratuity or any perquisites that are paid to the employees. Who are employees? They can be part-time, they can be full-time, they can be contractual, they can be retainers, they can be anyone, right? Now, the benefits that we pay are an obligation. This obligation can come from a formal agreement. Okay, then can come from a law body. Okay, law making body. Okay, basically the local laws or the local legislations. Okay, wants us to make these payments. Okay, or constructive obligation, you can say. It can be constructive obligation as well. Okay, basically the entity says on their self that I have to pay this amount to my employees. Okay, that can be constructive as well. Now, loan to employees. Is it covered here? Loan to employees, tell me. Is loan to employees covered here? Is loan to employee covered here? No. Loan to employees are not covered here. Covered in IFRS 9. Covered in IFRS 9 on financial instruments. Okay. But understand, guys, a portion of the loan to employees are also covered here. I'll tell you why. See, when I give a loan to my employee at market terms, okay, at market terms, am I giving any benefit to my employee? Am I giving any benefit to my employee? No. So that's not here. Because that's in the market. If I give a loan to my employee at the market terms, no benefit. But if I give a loan to my employee at a less than market rates, but it is then I am giving a benefit to my employee, and then the differential interest rate. Let's suppose the market rate is 9% and I have given loan to my employee at 0% or 6%. This difference can be said as employee benefit expense, which we have already studied in the financial instruments chapter. Okay, so not covering that again. So what are the type of employee benefits which we have to discuss here? That is short-term employee benefits, long-term employee benefits, post-employment employee benefits, and termination benefits. Whatever benefits are to be paid within 12 months or from reporting date, are covered as short-term benefits, short-term employee benefits. If any benefit is to be paid after 12 months from reporting date, that is called as long-term employee benefits. If any benefit is to be paid to the employee after their retirement or after their resignations, it is called as post-employment employee benefits. Okay, whatever benefits we pay to the employees to terminate an employee, it is called as termination benefits. Okay, now short-term employee benefits. Though termination benefits are not a regular topic in the exam, but can be asked. Why? Because we see a lot of terminations happening in the market these days, right? Facebook terminated their employees, Twitter is terminating their employees, right? And in the past also I have seen 3-4 companies, the startups, right, the US startups and the Indian startups too, right, have fired their employees, right? So these are you can say, though it is not a current issue declared by the ACCA Institute, but it can come up. Okay, you never know. Okay, so the treatment is very simple though. Okay, it can come up. I can just presume that it can come up. Okay, not necessarily. Leave short-term employee benefits. The most important example for short-term employee benefits is leave encashment. Understand, guys, the leaves that you get in your job. All of you are working, I believe, right? So wherever you work, you get leaves, right? The leaves are entitled to you during the year. So understand how the accounting happens for that leave. Understand, guys. If the leaves are accumulating, means you can carry forward to the next year. Let's suppose you are given 5 leaves during the year. Is that sure that you will avail all the leaves during the year? Is it sure that all the leaves are availed during the year? No, you cannot. You can or you cannot. Okay. Nutan is asking where current issues are declared. As part of the latest articles. Current issues are declared. Okay. Now, leave encashments. Okay. So if the leaves can be accumulated, okay, then understand in the next year how those leaves are treated. Okay, in the next year, you can adjust these leaves by taking leave only. Let's suppose at the end of the year you have 2 leaves remaining. In the next year, either you can take leaves against these, okay, or these leaves will be lapsed. The second option, either you can take leaves. If you are not able to take leave, you can encash it off. Now tell me, in both options, in this option where the employee can take leaves or otherwise it will lapse, don't you think we have to calculate a probability that what is the probability that the employee will take leave? What is the probability that the employee will take leaves? Tell me yes or no. Because there are chances that these leaves can lapse. But in this case, sorry. In this case, we are not required to create provision. We are not required to estimate probability. Why? Because see, either the employees will take leaves. If not, they will encash. So in any manner, the entity has to pay for it. It's certain. Either leaves, or if not leaves, then pay for it. Okay, then actually pay for it. So in this case, I will not estimate a probability, rather I will create a provision fully. But what if the leaves are not accumulating? What if the leaves are not accumulating, non-accumulating? So in that case, there can be two options. At the end of the year, let's suppose I have 2 leaves. These leaves I cannot take it to the next year. There can be two things. Either the leaves can lapse, the leaves will lapse, or the leaves can be encashed. Right? Only these two options can be there. If it lapses, ignore, no treatment, right? No treatment. But if it can be encashed, the entity has to record a liability for that. Tell me, is it clear, everyone? Come on, guys, tell me. I'll explain it again, don't worry. Understand? You can say, okay, if your query is why provision, why not liability? See, understand. Don't you think your employees can leave? Okay, or if then leave, then also have to pay. Do you know at this year end what is the exact amount to be paid? Right, because the salary of the employees will increase or decrease. Though you can estimate, but you don't know the exact amount. Right? You don't know the exact amount. Tell me, Siddhant, yes or no? You don't know the exact amount. Tell me yes or no. In this case also, you don't know the exact amount. Right? Because the salary of the employees can increase or decrease. So I don't know what is the amount. What might be the amount? See, in this case, I can say probable obligation. In this case, I will say present obligation, but the amount is not certain. In this case, I can say amount, this is a probable obligation. Okay. Now understand how to calculate this provision. Of the liability. The provision amount is equals to opening leaves plus entitlement during the year minus leaves availed during the year. Okay, is equals to carry forwarded leaves. But now again there is a concept of LIFO and FIFO. What does it mean? When you avail these leaves, the question comes up, from where you are availing, from here or from here? Let's suppose you have opening leaves of 2, entitlement is 5, and you have availed 4 leaves, and the entity's policy is you can accumulate your leaves but only for 12 months. This is generally this is the policy, that you can accumulate your leaves but only for 12 months, not beyond that. Now see, if the policy is LIFO and if the policy is FIFO, how does it change? I'll explain. If it is LIFO means last in first out, means this 4 I will take it from here. So what are my carry forward leaves? My carry forward leave is only 1. Why? Because see, these 2 is already being carried forward from the previous year. I will not be able to carry forward to the next year. Why? Because the carry forward can happen only for 12 months. Right? So these leaves will get lapsed. So in that case, only 1. In LIFO, I will get only 1. If it is FIFO, see, this 4 means first in first out, means 4 I will take it from 2 first, and then 4 I will take it from here. So I will take 2 from here. So the balance is 3. These 3 can be carried forwarded, right? Carry forward the who written in question means carry forward will be written in the question. See, the question will give you opening, the question will give you entitlement, the question will give you availed. Okay, you have to calculate carry forward. The question will give you LIFO or FIFO. You have to calculate the carry forwarded. You have to calculate carry forward in the question. Okay, the question will give you the data. You have to calculate carry forwarded. Okay, now in the carry forward leaves, okay, the provision is equals to, again, carry forward leaves multiplied by expected salary per day in next year, multiplied by what is the probability that the leaves will be availed, if the probability is required to be multiplied, right, multiplied by number of employees, and this will give you the provision amount. This will give you the provision amount. This will give you the provision amount. I hope it is clear to everyone. Carry for 12 months is written in the question. Understand, guys, carry for 12 months is I am assuming it off. Okay. I'm assuming it off. Okay. You can the question will specify whether it is to be 12 months or more than that. Okay. The question will specify everything. Don't worry. Here I am assuming it off. Okay. I hope this formula is clear to everyone. Now come to the next type, that is post-employment employee benefits. It can be of two types. One is a defined contribution plan and one is defined benefit obligation or defined benefit plan. See, in defined contribution, the entity's obligation is to contribute every year, and then the responsibility is over. Every year you contribute a fixed amount and your responsibility is over. But in defined benefit obligation, you have to give a certain amount on the retirement or on the resignation. You have to give a certain amount at the time of retirement or resignation. So a certain amount. So whether you are contributing every year or not contributing every year doesn't matter. Your obligation is to give a certain amount to the employees at the time of resignation. So that's why I'm saying defined benefit obligation, defined benefit plan. So it's an obligation for the entity. Right? It's an obligation for the entity. Now what is the accounting? How the accounting happens for DBP or DBO, defined benefit plan, defined benefit obligation. So first you have to calculate the benefit that you have to pay. You have to estimate. Rather than saying calculate, I'll say estimate the benefit to be paid on retirement. Okay, and then calculate the present value of the benefit, right? Then prepare a liability schedule. In future, the estimates might change. What are the estimates that you use for calculating the benefit? You use estimates like what will be the salary escalation rate or salary hike rate, what will be the discount rate, what will be the salary, right? All these are estimates. That you are using to calculate the benefit paid, okay? In the future, these estimates might change. The salary, let's suppose I assumed that the salary will increase every year by 10%. In the next year, salary increase by 30%. That can happen, right? The employee performed exceptionally and he got a promotion and his salary increased by 30%, right? The estimates are changing, right? Or the discount rate I am estimating now is 10%. In the next year, let's suppose the discount rate changed to 20% or 15%, right? The estimates again changed, right? Number of employees, number of employees you can say, yes, you can say number of employees as well. Okay, so all these are estimates, okay. Now I'm not saying about number of employees, because number of employees, guys, again it's not an estimate. You have the certain number of employees, right? It's done on the basis of the employees that you are having currently, not about the future employees, okay. So the number of employees is not an estimate. I'm talking about the discount rate or the escalation rates or the salary, right? I'm not talking about this one. So if the estimates changes, the change in the present value due to change in the estimates is transferred to OCI as actuarial gain or loss. And in the future, the plan changes. The plan itself changes. Let's suppose the plan is I will pay 6% of the last drawn salary. Now after 2-3 years, the entity had a certain plan changes, and the entity told no, not 6%. I'll pay 8%. The entity was performing exceptionally well. The employees were performing exceptionally well. The entity was very happy with the employees. Entity told, when you guys will retire or resign, rather than 6%, I will pay 8%. That's a change in the plan. So when the plan changes, the change in the plan is transferred to P&L as past service costs. Okay. Now I am taking up an example which I took in my regular class as well. Okay. But the solution is already here, so we'll discuss the solution. Okay. Now let's understand, guys. Example number 1. Read the example, all of you. Read the example, all of you. The example is in front of you. Read the example. Okay. Zomato has defined benefit plan or at the rate of, what's the plan? See, this is the plan, this is the plan. 6% of salary is the plan, okay, for each complete year of service. Okay, 6% of last drawn salary, 6% of last drawn salary, you can write here, last drawn salary. 6% of last drawn salary for each completed year of service. Okay, number of employees are 100, average salary is $10,000 per annum, annual hike is 5% per annum, and the average retirement period is 5 years. So now, first calculate the benefit that you will pay after 5 years. Tell me what is the benefit. Now, first calculate the salary, last drawn salary. So what will be the last drawn salary? First calculate that. Let's calculate it here. Last drawn salary. Tell me what is salary at the year end 1? What is salary at the year end 1? So we are doing this calculation at year end. We always do these calculations at year end. So what is salary at year end? $10,000. $10,000. Right? Hike is how much? 5%. Right? So at the year end, this is salary. At year end 1, this is salary. 1.05 will make at the year end 2. 1.05 will make at year end 3. 1.05 year end 4. And 1.05 year end 5. Right? So this is the calculation of salary. Can you please calculate these figures? So it will come to 10,000 into 1.05 into 1.05 into 1.05 into 1.05 is 12155. 12155. So now this is the last drawn salary right here. This is last drawn salary. This is your last drawn salary multiplied by 100 employees, multiplied with the benefit paid is 6 years, 6%, and the completed year of service will be 5 years, right? So if you multiply that, it will come to 3,64,650. 3,64,650. Now, what is the benefit per year? What is the benefit per year? Because we are calculating the cost for per year also, right? Now, this is the benefit to be paid for the 5 years. Per year is this much, divided by 5 years is 72930. Now we have to calculate the present value. See how we will calculate the present value. See, every year I will incur a cost of this much, but I will pay when? See, this amount I will pay here, this amount also I will pay here, this amount also I will pay here, this amount also I will pay here, this amount I will pay here. So this amount I am paying here itself. So the present value factor is 1, right? At the rate of what is the discount rate? Tell me what is the discount rate? Discount rate is how much? Have I given the discount rate in the question? No. Ideally it should be 9%, I believe. 1.09 divided. Yes, it at the rate of 9%. Though I have missed to give in the question, you can write here discount rate is 9%. Is 9%. Okay. Discount rate is 9%. Now understand. So the expense per year is this much. Discount rate is 9%. So this will be paid here. This will be paid after 1 year, after 2 year, after 3 year, after 4 year, right? So this is the present value. These are present values of all the amounts. Now let's prepare a liability sheet. Year end 1, I will record this amount as an expense. This amount as an expense, right? So this is my closing liability because I am doing at the year end 1, so no interest cost. This amount will become the opening for the next year, right? On which I will charge an interest at the rate of 9%, right? And this is the 56315 is coming from here. This 56315, sorry. Write like this. It's coming from here, right? This 61384 is coming from here. This 66908 is coming from here. And this 72930 is coming from here. Okay. So all these amounts, this current service cost, basically these will form current service cost, CSC, current service cost for respective years. Okay. Now this current service cost is transferred to P&L as employee benefit expense. This interest cost is also transferred to P&L as employee benefit expense. So don't be mistaken that this, since this is an interest cost, I will transfer to finance cost. No, even if this is an interest cost, this is pertaining to the employees, right? So I will transfer it to employee benefit expense only. Transfer it to P&L as employee benefit expense. Okay. Now generally this is what will happen. Generally this is what will happen. Now let's change the estimates in the next year. Continuing with the above example, at year end 2, let's suppose the actual salary at year end 2 is 12,000, right? That can happen, right? Is it not, it's not certain that this, see, according to this one, what should be the salary at year end 2? 10,000 multiplied by 1.05 is 10,500. But the actual salary can be more than the estimated salary, right? The actual salary can be more than or less than the estimated salary. Is it clear, everyone? Is it clear so far? Example number 1 is clear to all of you? Example number 1 is clear to all of you? Very good, very good. Now coming to example number 2. Okay, at year end 2 salary is this much, actual salary is this much, annual hike rate is this much, discount rate is 10%. So can you please tell me, can you please calculate, all of you, what should be the last drawn salary? What should be the last drawn salary? That should be ideally 12,000 multiplied by 1.08. This is at year end 2, this is at year end 3, 1.08 at year end 4, and multiplied by 1.08 at year end 5. So what is the amount? 12,000 into 1.08 into 1.08 into 1.08 into 1.08, right? That is 15116. Is 15116. No, Nutan, I think there is some mistake that you have done. It should be 12,000 into 1.08 into 1.08 into 1.08 is 15116. Okay. Now, so this step is clear. Now calculate benefit. So this is the last drawn salary plan, employees 5 years. So this is this one. Benefit per year is this one, right? Now what I will do? I will repeat the same steps again. I will calculate the present value, which you guys are sure now. I will calculate the revised liability sheet. Now tell me, we are where? We are standing where? Tell me. We are standing on what day? Tell me. At year end 2. At year end 2. Tell me what is the closing liability at year end 2 as per the revised schedule? 136,282, right? But now what are we estimating? The estimates are changing at year end 2. The estimates are changing at year end 2. Can I say that, did I say that estimates are changing during the year? No, estimates are changing at the end of the year. So how will I record the expense during the year? See, it will work like this. It will work like this. See here. See, it will work like this. Understand? Understand? During the year, tell me what is my opening, during the year, tell me what is my opening liability? What is my opening liability? Tell me, can anyone say? What is my opening liability? Can anyone say? 51665, right? See, this is what is the opening. This is the opening, right? So I'll write my opening liability is 51665. 51665. Now during the year I'll record current service cost and interest cost. Will I record as per this one or as per this one? Tell me. The current service cost and interest cost I will take as per the prior estimates or as per the current estimates? As per the above one, right? Why? Because the estimates are changing at the end of the year, not during the year. So what is the estimate? 56315 and 4650. 56315 and 4650, right? 56315 and 4650. So what should be my closing liability? Tell me what should be my closing liability? Tell me. 51665 plus 56315 plus 4650 is how much? Tell me. Is it becomes how much? Tell me. 51665 plus 56315 plus 4650 is 220610. 220,610. Okay, 220,610. Now understand. But my liability is, tell me how much? As per the revised estimates, what is my liability? 136,282. So what shall I do? What shall I do? Tell me. Tell me what shall I do now? What shall I do now? So the differential, the difference between this and the this, I should record as what? I should record as what? Actuarial gain or loss. See, my liability is what? How come this is coming 220? No, I think I have done some mistake in the calculation. It's not 220. Let me recalculate. It's 51665 plus 56315 plus 4650. It's 112630. 112630. Yes, Nutan. Okay. Now, so this see because of this my liability increased. So it is my actuarial loss. And what is the amount? Tell me. Minus 136282. 112630 minus 136282 is 23652. 23652 is what I have to record. Okay. Now see how the journal entry will look like. See here now. Current service cost 56315. See, current service cost I will record this one 56315. Interest cost 4650. See this one, right? The actuarial loss which will be transferred to OCI 23652. See here. Okay, fine. I believe it's clear, everyone. Right now, and the defined benefit obligation is transferred, is changed this much. Opening was 51665 and the closing becomes 136282. Closing becomes 136282. Is it clear, everyone? Is it clear, everyone? Is it clear, everyone? Now see example number 3. In this the estimates are also changing and the plan is also changing. See here, plan is also changing. Plan is changing from 6% to 8%. See here, right? So what I'll do, first I will calculate for before the change of plan. Before the change of plan, what is the change in liability? Before the change of plan, what is the change in liability due to change in the estimates? Because see, the estimates are also changing and the plan is also changing. Reason before transferring to OCI. Tell me, Nutan, is it certain? Nutan, is it certain? Is it certain that I will pay this amount? Or is it certain that this amount will be paid? The employees can live in between also, right? Like let's suppose I will give the example for India. To take gratuity, the employees have to serve 5 years. So right. So don't you think there are a lot of employees who leave prior to 5 years, right? So there is a high level of uncertainty attached, right? That's the reason why we are transferring it to OCI, not to P&L. Okay. So in this case, first I will calculate the change in the liability due to change in estimates, which I will transfer to OCI. Then again I will calculate the change in liability due to change in the plan, and this change in plan, this amount is transferred to past service cost. See, I will show here. See, I'll show it here. See. Okay. See this part. Closing liability at year end before change in plan, but after change in estimates. Okay, but after change of estimates is this much, and after as per the revised plan, that is at the rate of 8%, right? Okay, this is at the rate of 6%. So this is 347258. The amount is 8686814. The amount is 86814. This amount, see here, this amount is recorded as past service cost and will be transferred to P&L, right? The amount, the change due to actuarial loss is transferred to OCI. Okay. So you can see this example. The solution is already given here. You can see this example. Okay. Still, if you have any queries, we can definitely discuss on that. Okay. So I am not discussing the prior part of this example because that's the same again the repetition of the what we've already discussed. So I don't want to discuss that part again and again. But yes, that's the reason why I pasted the solution, complete solution here, so that once after the class you can revisit this example and try to understand it. If you have any issues, definitely we can resolve it off. Okay. I believe it is clear, everyone. So far. Now tell me, Nutan, Siddhant, Ayush, Neha, Yogesh, Vishakha, all of you, Arun, tell me guys, come on, do you think this standard is difficult? No. No, 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 not at all, not at all, not at all. You guys just are employee benefit is something irregular that many of us don't have a practical exposure in, and that's the reason why we don't feel that this is a why we feel that this is a difficult standard. Okay, and you guys are not wrong at your place as well. I remember when I was a student, I used to feel this is a difficult standard, and when I was in CA final, even I left this standard and went for exams. Okay, but I will never recommend you guys to leave the standard any of the topic in ACCA. I will tell you why, guys. In ACCA, the examiner team says that it's better if you broaden your coverage. You should cover each and every topic. If you're not having the much detailed understanding of everything, if you're not having much detailed understanding of any topic, it's fine. But understand, you should cover topics. At least you should cover each of the topics. Why? I'll tell you. In the examining team says that if a question comes up for 10 marks, or let's suppose if a question comes for 25 marks, okay, if a question comes for 25 marks, you know what? The examining team tests it for when the examining team starts evaluating your answer, they evaluate for 30 marks. You know what? If you have done 5 mistakes in your answer, okay, and 25 points are correct in your answer, they will ignore the 5 wrong points and they will give you 25 full marks for the 25 correct points which you have written. That's the best part. So always increase your coverage. Your coverage should be more. Okay. So don't leave any standard. Okay. Don't leave any standard. Pension fund is an example of DCP, not defined contribution plan. It's an example of DBP, defined benefit plan. Why? When is pension paid? Tell me. Ayush, tell me. Right? Now, understand. Siddhant, I think we have already discussed in the live class as well that the answers are very long. I totally agree. But you are not supposed to write that long answers. Write in your own words, but give just fulfill all the requirements of the answer. Okay. Read the question properly and write to the point. That's all. If you're writing anything extra, if you have time, if you can write anything extra, you can do that. Okay, you can do that. But ensure that you are when you're writing anything extra, that should not be at the cost of a question. So that if for a 25 marks you have written for answer for 35 marks and you left one question of 25 marks. Don't do that. Okay, Siddhant? Now, defined benefit obligation. Can be funded or can be unfunded. Why? What is the meaning of funded or unfunded? Understand, guys, when I have an obligation to pay after certain years, all of you, tell me, don't you think so? Let's suppose we want to go for, let's suppose I want to go for a Goa trip, okay? I want to go for a Goa trip, okay? And I know that I'll go for a Goa trip, or let's suppose in January, okay? Now, me and my friends made a plan to go on a Goa trip, okay? Though we are making it from a very long time and we are not able to go, okay. So what will happen? I know that if I will go on a Goa trip, it will cost me somewhere in the range of 35K. So what will I do? Every month I will start accumulating the funds for that, right? Every month I will start accumulating the funds for that. Every month I will start contributing the funds for that, right? Okay. Now, when I start contributing the funds for that and I fund it, right? So that's called funded scheme. That's called as a funded scheme. Okay. But what if I do is I have to go on a Goa trip. Okay. And what I do is on the day when I have to go Goa trip, I don't fund it. I don't accumulate the funds. When I have to go on a Goa trip, then that time I will pay it off. Okay. So I don't accumulate the funds. That's called unfunded. Okay. So basically, if I know that I have an obligation to pay, and for that obligation, if I'm investing it somewhere, if I have for an obligation, I'm investing it somewhere, that's called funded scheme, okay? And the amount that we invest are called as plan assets. The amount that I'm investing are called as plan assets, okay? Now, understand. Vishaka, it can be in the nature of both. We have to see the question and understand it off, okay? Now, presentation in FS, how do we present? So, we present the net, understand how? Understand, guys. So, we write here in the FS, present value of defined benefit obligation minus plan assets is my net obligation, This is how I have to present in the FS. This is how I have to present in the FS. I hope it is clear, everyone, the presentation in FS. Now comes the ceiling test. The ceiling test, I have to study two things here. When I have to do ceiling test and how I have to do ceiling test. When and how. Oh, okay, Yogesh, I'll cover that, don't worry. Unfunded shows the asset, company's asset rich. You can say that basically you have made a provision for your obligations, okay? You are already ready for your obligations, okay? Funded shows that you are ready for your obligations. See, unfunded shows it can or it cannot, okay? Unfunded also gives a picture that the company is not future seeing, okay? Is not future seeing. Now, when the plan assets, when the value of the plan assets exceeds the obligation, exceeds the obligation, in that case we can say that it is a we have to check for the ceiling test. Why? See, here in this case we are showing net obligation, but what happens if the plan assets are more? I have to disclose the plan assets. Means I am disclosing an asset. Now understand, guys, whenever you disclose an asset, you have to test it for recoverability. You have to test it for impairment. And this ceiling test is nothing but the impairment test of, you can say, of plan assets. Is nothing but impairment test of plan assets. Okay, now how do we need to do that? Okay, see, then what we'll see is what will the net plan assets, okay, how will I do it? I'll write here, compare net plan assets with what? Tell me, compare net plan assets with what? With fair value of refund. See, understand, guys, if I'm having a plan assets, right? Excess plan asset means I will get a refund, right? Let's suppose my plan assets are you can say 3500 and my obligation is 3000, means I will get a refund of 500. I'll get a refund of 500. Then I will compare this. What is the fair value of refund? What is the refund value that I am expecting? If, see, this is 500 and I am expecting that I will get a refund only of 400. Might be due to a lot of situations, like fair value changes or any other cases, okay, 400. So what will I do? I will impair, in that case, I will impair the plan assets by 100, and this is called as ceiling adjustment, which will go to OCI, Is it clear, everyone? Is it clear, everyone? Okay. Now comes to the last point for this one, post employment employee benefits, cancellations. Now what is happening? Understand, guys. Cancellations means you are saying to your employees, boss, I don't have the funds, I will not be able to pay it to you. I will not be able to pay it to you. But you have already recorded a liability. Tell me, you have recorded a liability, right? So you have recorded present value of defined benefit obligation. But when you are saying to your employees that I will not be able to pay, is that liability holding good? Is that liability holding good? Tell me. No, right? So it's liability no longer required, return back. So what will you do? To gain on cancellation, you will record it as a gain on cancellation. Not exactly, Ayush, not exactly, but yes, your logic is correct. Okay, with compensation. So what will I do? I will again see, because I am cancelling the plan. I am cancelling the plan. So this obligation is no longer required to be recorded. Okay, but yes, if I am paying a compensation, I will do to bank whatever compensation I paid, and the balancing figure will be called as to gain on cancellation. To gain on cancellation. Okay, is it clear, everyone? Is it clear, everyone? The cancellation. Is it clear, everyone? Okay, now long term employee benefits. I will say here same as post employment employee benefits, but only one difference. Let me see who can answer it. What is the difference? Tell me. What is the difference? Tell me. What is the only difference between PEEB and long term employee benefit? Only one difference. Tell me what. The actuarial gain or loss is transferred to what? Guys, I've said everything now. Please come on, answer. Low on energy, P&L, right? Why? Because the uncertainty here is very less. The uncertainty here is very less as compared to post employment employee benefits. Okay. Now termination benefits. I will record expense and record a liability. I will record an expense and I will record a liability. Provided both the parties, that is employee and the employer, have agreed on it. Both the parties agree. When both the parties agree, I can record an expense and a liability. Now, so that's all for this one. Now, if I have to answer what are the items of OCI, I'll say actuarial gain or loss on defined benefit obligation, actuarial gain or loss on the plan assets. Okay, now the ceiling adjustments on the plan assets. Okay, these are the items which will go to OCI. Now moving on to the third topic for the day, that is income taxes. Let's take a quick break of 5 minutes and then we'll discuss the income taxes. Okay, let's take a quick break of 5 minutes. let's start it, guys. Let's resume the class. Yogesh has a query. I always do rote learning when it comes to OCI. Not sure about the logic of OCI. Okay. Understand, Yogesh, and everyone, that whatever is the gain or loss which we are uncertain to realize. Okay, it not, see, we have a wrong notion that it is notional transferred to OCI. No, whatever is a gain or loss which we are uncertain to realize, okay, those gain or loss goes to OCI. Those gain or loss goes to OCI. And in our last class, in this revision session as well, we will be discussing that what are the items of OCI, okay, and which among those are you can say recyclable, which among those are not recyclable. All those things are we will discuss in the last class. Okay, we will be discussing that now. But understand that the only logic is if there is any gain or loss which you think is not realizable. Let's suppose, for an example, the revaluation gain on non-current assets. Do you think that is that will be realized? Do you think there is a high uncertainty that it will not be realized, right? But again, forex gain or loss, that's notional, but we go to record it in the P&L, right? We record in the P&L. Why? Because we are certain that though it's notional, but we are certain that we will realize it off. Right? So that's the only logic. Now come here. Topic 3 for the day is income taxes. In the income tax, understand, guys, in the P&L that we record tax expense. There are two components for tax expense. One is current tax, and another is deferred tax. I believe all of you are clear on these two parts. Now we have to discuss the current tax also. We have to discuss the deferred tax as well. Though deferred tax is a more prominent tested topic as compared to current tax in the exam. Okay, now let's discuss. Current tax is a very small topic. Okay, Okay, understand. Current tax. The debit balance of current tax shows that it's an under provision I have made in the previous year. Okay, I have made under provision in the previous year. I have made a provision of X, but I have paid an amount of over and above that. Okay, that's the reason why it is showing a debit balance. Okay, why it is showing a debit balance? So it means I have to record the excess as an expense in the current year. But a credit balance means there is still a balance. Let's suppose I made a provision of 100, out of which I paid only 80. So there is still a balance remaining. Okay, so I will adjust in the current year. So let's suppose if the balance of 20 is remaining, and in the current year I have to make a provision, let's suppose 60. In the current year I have to make a provision of 60. 20 is already remaining, so I will make a provision of 40 only. Okay. In the earlier case, if I have to make a provision of 60 in the current year and 20 is excess I have paid in the previous year, right? So I will make a provision of 60 plus 20 as 80. So here, see here, whenever it's a debit balance, I will add as an expense in the current year, and whenever it is a credit balance, I will reduce from expense in the current year. Okay, plus I will adjust whatever is the provision required for the current year, and this plus the adjustment of these two gives you the current tax expense that will go to P&L. Tell me, guys, is it clear, everyone? Current tax is clear, everyone? Current tax is clear, everyone? Come on, guys, tell me, is current tax clear to everyone? Deferred tax is a very small topic now. If you understand current tax, the next is deferred tax we have to study. Okay, now let's understand deferred tax. Step 1 is carrying amount. We have to calculate the carrying amount. What is the carrying amount of the set? So that is already given, right? That is as per IAS or IFRS, as per IFRS, right? Now then we calculate what is the tax base. What is the tax base? Tax base means carrying amount as per tax books. Tax base is the carrying amount as per tax books. Now the difference of the carrying amount as per accounts books, difference of the carrying amount as per tax books. Okay, these two these two will give you the temporary difference. These two will give you the temporary difference. Okay, that's what is called TD, temporary difference. Okay, that is carrying amount minus tax base. Carrying amount minus tax base. Okay, now step 4. Once I have calculated what is the temporary difference, then I will assess what is my what is it taxable or deductible? Is it taxable or deductible? If it is taxable, what is the meaning of taxable or deductible? Meaning thereby, if it will increase my future tax liability, it is called as taxable. If it will decrease my future tax liability, it is called as deductible. It is called deductible. Okay, so taxable, we will make deferred tax liability taxable, temporary difference multiply the tax rate in the country. I will make it as a deferred tax liability. Deductible temporary difference multiplied by tax rate in the country, I will make it as a deferred tax asset. Okay, but deferred tax asset, we have to understand one more thing. That we will make all the deductible temporary difference will be recognized as deferred tax asset, provided the prudence conditions is met, or provided, what is the meaning of prudence? The future profits are there. See guys, understand, if I have a deduction to take in the future, I can take deduction against profits. If the profit itself is not there in the future, against what I will take deduction? So I will not, even though I can take deduction in the future, but since I don't have in the future, I will not have profits, I will not be able to utilize this. I will not be able to utilize this one, and hence these deductible temporary difference will just be disclosed in the balance sheet as unrecognized temporary difference, which will be assessed on every reporting dates. If it becomes recoverable, if you think that yes, you will have future taxable profits, it is in that year you will recognize this unrecognized temporary difference as deferred tax asset. Okay, if it is taxable, will not assess for anything, directly will recognize a deferred tax liability. Okay, so I will assess for prudence limits. I will assess it for prudence limits. Now recognition exemption. Standard says that on goodwill I will not recognize deferred tax. Why? Because the goodwill is not tax deductible. Okay, goodwill is not tax deductible. So the reason is since it doesn't have any tax consequences, I will not recognize any goodwill. I will not recognize any deferred tax on goodwill. Okay, and if I try to recognize that, it will create a loop. How? See here. Tell me, can I recognize goodwill which is self-generated? No. I can recognize goodwill only in the case of business combination. Is it clear, everyone? I can recognize goodwill only in the case of business combination. Is it clear, everyone? Now, don't you think in business combination entry, the goodwill is the balancing figure? Now, if I recognize deferred tax on this goodwill, again my net assets will increase or decrease, and the goodwill figure will get impacted, right? Now, again this goodwill figure get impacted. Again, due to this, I have to change my deferred tax asset or deferred tax liability, right? Again, it will change my goodwill. So it will create a loop. And we have discussed how these loops get created. We have discussed this multiple times in our classes, that how these loops get created, right? That's the reason why we don't recognize a deferred tax on goodwill. Now, we will not recognize deferred tax on asset or liability if it is not arising on business combination. We'll discuss this point separately. And if it doesn't impact any accounting profit or taxable profit, there is no impact on accounting profit or taxable profit. So in that case, it means that if it doesn't have any tax consequences, don't recognize any deferred tax on that. Okay, it's simple. Coming to step number 7, deferred tax on unused tax losses. Okay, meaning thereby whatever carry forward of losses you have, if you are virtually certain that you can adjust these losses which against future profits, recognize deferred tax for that. Or if you are having any credits, that is MAT entitlement. An example for that is MAT entitlement, right? Recognize deferred tax for that. Okay. Now, deferred tax impact will go to P&L, or it can go to OCI, or it can go to equity, depending upon the impact of transaction. Like let's suppose Deferred tax impact on non-current assets. Tell me, where does the impact go? P&L, equity, or OCI? For a non-current asset, the depreciation goes to P&L. So the deferred tax impact for non-current assets will go to P&L. Now revaluation reserve. Where does it go? P&L, OCI? P&L or OCI? OCI. So the deferred tax impact will also go to OCI. Now comes the presentation. In SOFP, I will show the net amount. Okay, I show the net amount provided it is from the same legislation, it is from the same law. Okay, deferred tax liability minus deferred tax asset provided same law. Okay, let's suppose Infosys in India, Infosys has a deferred tax liability from as per Indian Income Tax Act, and has a deferred tax asset as per the US Income Tax Act. Can I set it off? I cannot do net off. I have to show separate deferred tax asset and a deferred tax liability, right? When equity, if it's an equity transaction, right, and I have to create deferred tax on that, so the deferred tax impact will go to equity. Okay, Vishaka? Now, if there is an increase in deferred tax liability, it will be a deferred tax charge, that is expense. Charge means expense. If deferred tax liability decreases, your liability is decreasing, it will be your income, right? So we call it as deferred tax credit. Why do we say credit? Because it will reduce your expense. Okay, again, increase in deferred tax asset, it will be an income, that is it will reduce your deferred tax expense, right? Now decrease in deferred tax asset, it is an expense. That's why it is called as a deferred tax charge. Okay, it can go to, the impact can be in P&L, impact can be in OCI, impact can be in equity, depending upon the transaction. Now, I believe it is clear to everyone. So far. Can you please confirm, guys, if it is clear to everyone so far? Is it possible to adjust? Nutan, yes, provided it's against the same law, it's for a same law, and you can do that. Okay, you can transfer your losses to the group companies. Okay, you can transfer your losses to your group companies, then you can do that, otherwise no. Now understand the special cases. See, the standard says that if you have practically, if you can net it off, you are expecting to make a net payment, it is then only you can. No, not covered. Okay, practically if you can adjust it off at a time of payment, yes, you can do net, otherwise you cannot do net off. Okay, netting, offsetting is allowed only when you can practically avail that benefit. Okay, now understand leases. See, from a carrying amount of leases, we record lease liability and we record ROU asset, and you will understand that on the lease commencement date, generally both of them are same, right? If we remove the impact of initial direct cost or provision for decommissioning liabilities or lease incentives, if we remove the impact of that, right, generally both of them are same, assuming that. Tax base is nil because tax base does not recognize lease liability and ROU asset. Tax books does not recognize that, so tax base is nil. Temporary difference on lease commencement date will be nil. Why? Because this will be the same, and tax base is also nil, right? If this is X, this is also X, so if I asset minus liability, if I do, it will become nil, right? Nil minus nil, so on lease commencement date it will be nil. Right? Now on lease commencement date, I'll write here. Right? Subsequently, Subsequently, this will definitely have a balance. Carrying amount will have a balance because lease liability gets unwinded. Lease liability gets unwinded, but ROU asset gets depreciated. So ROU asset value decreases. ROU asset value decreases, right? But lease liability gets unwinding. So this will have a balance. Okay. So whatever is the balance, whatever temporary difference comes up, we have to analyze. We have to analyze that this temporary difference is taxable or deductible. Generally, it will be taxable. Deductible. Generally, it will be deductible. Generally, it will be deductible. So we have to create a deferred tax asset on that. No tax consequences. Then why to consider this? Why are you saying no tax consequences, Vishaka? Don't you think the lease rental that we pay is recognized as an expense in the tax books? There are tax consequences of this transaction, right? But in a different manner, right? In your accounts books, you record finance cost and depreciation, but in your tax books you record rent expense, right? Because the account tax book doesn't say recognize lease liability and ROU asset. They doesn't recognize that. Okay. So there are tax consequences. We cannot say that there are no tax consequences, right? And we have to recognize deferred tax asset or deferred tax liability depending upon whether it is a taxable temporary difference or deductible temporary difference. Generally, it will be deductible temporary difference. I am talking about generally. Is it clear? Is the deferred tax impact on leases clear, everyone? Vishaka, understand. If we are talking from an asset perspective. We are talking from balance sheet perspective, right? We are talking from balance sheet perspective. Tell me, does the tax books recognize lease liability and ROU asset? Does the tax books recognize lease liability and ROU asset? No. No, they don't recognize. They don't recognize. Right? But that doesn't mean that this transaction, this lease transaction, does not have any tax consequences. Right? In a different manner, but they do have tax consequences, right? They do have tax consequences. So I cannot say that lease transaction itself doesn't have tax consequences. They do have it, but in a different manner. I hope it is clear. Okay. Now coming to financial assets. At fair value. Understand, guys. This fair value can be through P&L, through OCI. Okay. Now carrying amount is at fair value. Carrying amount will be at fair value, and tax base will be at cost, because the tax books again doesn't recognize the fair value gain or losses. The notional fair value gain or loss is not recognized by the tax books. Okay. So it will be at cost. Okay. There will be temporary difference of fair value gain or loss. If gain, it will be taxable temporary difference. If it's a loss, it will be deductible temporary difference, right? Why it is a deductible temporary difference? Why? Because at the time when we sell, we will get a deduction of these losses. If it is gain, at the time when we sell, these gains will be taxable, right? So fair value gain is transferred to P&L, or it can be OCI. So if it is transferred to P&L, the deferred tax impact will also be transferred to P&L. If it is transferred to OCI, the deferred tax impact will also be transferred to OCI. I believe it is clear, everyone. In case if lease liability is higher than ROU, we will recognize DTA as DTL. Yes, IOS, you can say that. Okay. Now coming to share based payments, the deferred tax impact on share based payments. Understand? Share based payments can again be two types: cash settled and equity settled. If it is cash settled, we can calculate carrying amount, we can calculate tax base, right? We can calculate carrying amount, we can calculate tax base. This tax base we can then we can calculate temporary difference. This temporary difference we can calculate taxable or deductible. If it's taxable, then we'll say deferred tax liability. If deductible, we'll say it as a deferred tax asset. So and there is a movement in deferred tax asset or liability will transfer to P&L as deferred tax charge or deferred tax credit. I believe this cash settled part is very clear to all of you. There is no challenge. It's as normal as a liability, it's as simple as a liability. Now, about equity settled. See, carrying amount definitely we can calculate. But when we studied tax base, we said tax base of an asset or a liability. We never studied tax base of an equity. It's an equity, right? It's a reserve. So how to calculate tax base? How to calculate tax base? We cannot. So in this case, the standard says that you are not required to calculate this one. Definitely, rather its standard says that you have to recognize deferred tax asset as at the rate of future deductions multiplied by the tax rate. Directly you do that, okay? But yes, you can do that only if you have sufficient future taxable profits. Future taxable profits, okay? Carrying amount of provision for SAR, yes, Vishaka, yes. Now, this is a deferred tax you have to recognize. But now understand there is one challenge in this point. Though it seems very easy here, but there is a challenge here. Understand, guys, what is the challenge? Exception for equity settled share-based payment. When the future deduction as per the tax books, the estimated future deduction as per the tax books is greater than cumulative expense booked in the P&L, okay, it's greater than cumulative expense booked in the P&L, then the deferred tax impact for the excess, will not go to P&L, rather it will go to equity. I'll explain with the help of an example as well, okay? See here the example. If your employee benefit expense that you have booked is 12,000, but you are expecting that you will get a future deduction of 15,000, okay? Now, so standard says that for the differential that is 3 per thousand, the differential that is 3,000, tax rate in the country is 30%, 900, the impact of 900 will go to equity. So Visakha, you got the example. Why it will go to equity? Because it's an equity transaction, right? Till 12,000 it was a PL transaction. P&L transaction, right? For the rest, it's an equity transaction. Is it clear, everyone? So what is the general entry that I will record? Tell me. In this case, I will record deferred tax asset account debit. How much? Tell me. 15,000 multiplied by 30% is 4,500. 2. Deferred tax credit. P&L and OCI, right? And I'll transfer the movement, that is 3,600 and 900. That's what I'll do. Is it clear, everyone? So far? Now, the last part. Point number D, business combination. Understand? D, business combination. Very easy. Deferred tax impact on business combination is very easy. Understand, guys? When you acquire an entity, you acquire subsidiary assets and liabilities of subsidiary at fair value, right? So carrying amount is at fair value, but now tax books recognize it at cost, right? They recognize it at cost. So there is a temporary difference, right? Now for this temporary difference, you have to recognize deferred tax asset or deferred tax liability, right? Now second part again is on goodwill, which is already discussed, and the third part, existing deferred tax asset or unrecognized deductible temporary difference of parent. See, guys, understand what I'm trying to say here. Understand, please. Let's suppose a parent has a deferred tax asset. Parent believes that it will have sufficient taxable profits. If it will have sufficient taxable profits in the future, now it acquires a subsidiary. Okay, it's a merge with a subsidiary. Okay, let's suppose merged. Okay, when it merges, it believes that the future taxable profits will be adjusted with the loss of the subsidiary, and there will be no future taxable profits. there will be no future taxable profits. There will be no future taxable profits. Okay, so in that case, the deferred tax asset which I have recognized will be unrecognized. Now understand, when I or let's suppose another case, I have an unrecognized deductible temporary difference. Okay, and I acquire a subsidiary. My parent is a loss making, but I acquire a subsidiary which is very profitable, highly profitable. Then I believe that these unrecognized temporary deductible temporary differences will be adjusted against the profit of the subsidiary. Then I can recognize this one. Then I can recognize this unrecognized. So I can say that this can happen or this can happen. This change can happen. Yes, it can reverse as well. So for every assets, guys, we have to see the recoverability. See, though we have recognized an asset, it doesn't mean that it cannot be reversed. If it is not recoverable, it will be reversed. Okay, we have to reassess on every reporting dates that whether the recognized deferred tax asset shall continue to be recognized and whether the unrecognized deferred tax asset can be recognized. We have to reassess all these things on every reporting date. I believe it is clear to everyone so far. Okay, that's all for the day, guys. That's all for the day. Okay, we are wrapping up the session here itself today. Okay, thank you, guys. Thank you, all of you.